Hey there, friends. Whether you're thinking of investing in real estate or just curious about tax strategies, you're in the right place. Today, we're explaining the mystery of two big topics: the 1031 like-kind exchange and FIRPTA. How do these two tax rules interact? Can a foreign investor use the 1031 exchange to defer taxes on the FIRPTA? Stick around, and by the end of this video, you'll have a clear understanding and maybe a few tax strategies you can use. Let's get to it. First, let's break it down. A 1031 like-kind exchange allows U.S. investors to defer paying capital gain taxes when they sell a property as long as they reinvest the proceeds into a similar property. On the other hand, FIRPTA, short for Foreign Investment in Real Property Tax Act, ensures foreign investors pay taxes on gains from selling U.S. real estate. It requires a 15% withholding tax on the sales price, not just the profits. It is a lot to digest, right? But here's the key. Foreign investors can combine FIRPTA with a 1031 exchange to defer taxes. The most important factors are timing, compliance, and knowing the rules. So why does FIRPTA exist? In basic terms, the US government wanted to make sure foreign investors paid their fair share when profiting from US real estate. Here's a quick review of how FIRPTA works. When a foreign seller sells US property, the buyer or buyer's agent must withhold 15% of the gross sales price. This withholding acts as a prepayment of the seller's tax liability. Later, the foreign seller files a tax return to calculate the actual tax owed and in most cases claim a refund. But as you can imagine, not all FIRPTA sales are treated equally. When paired with the 1031 exchange, things get a lot more interesting. Now, let's talk about how these two tax strategies work together. A foreign investor selling US property under FIRPTA can use a 1031 exchange, but here are some things to consider. There's a like-kind requirement. The replacement property must also be a US-based real estate. Foreign properties don't qualify. There's a strict deadline. The investor has 45 days to identify a replacement property and 180 days to close on it. These deadlines are non-negotiable. There's also withholding issues. FIRPTA's 15% withholding still applies at the time of the sale. However, an informed investor can apply for a withholding certificate with the IRS to potentially reduce or eliminate the amount withheld, provided they comply with 1031 rules. In short, while FIRPTA adds layers of complexity, the 1031 exchange can still allow foreign investors to defer taxes. Now, before we rush into a 1031 FIRPTA deal, let's talk about obstacles. There's always paperwork overload. From IRS forms for FIRPTA to 1031 exchange agreements, the documentation can be daunting. It requires a lot of coordination. You'll need a qualified intermediary for the 1031 and a tax professional to handle FIRPTA filings. There's always timing pitfalls. Missing the 1031 deadlines or filing FIRPTA forms late can lead to costly penalties. So here are 3 quick tips. First, start the FIRPTA withholding certificate process early, especially because the IRS is currently delayed in processing applications. Number 2, choose a qualified intermediary who understands FIRPTA. This is key. And number 3, partner with a real estate tax expert to stay compliant. So what's the bottom line? If you're a foreign investor, combining FIRPTA and a 1031 exchange is totally doable, but it's not a do-it-yourself project. Surround yourself with the right team, plan ahead, and you could defer those taxes while keeping Uncle Sam happy. If you found this video helpful, please click on the like button, subscribe for more tax strategies tips, and leave your questions down below. I'd love to hear your thoughts. Until next time, thank you.